So welcome to Dublin. Obviously, most of you are already here. I'm delighted to be here. I was here for a tax conference yesterday, and we actually Leo Varadkar was speaking yesterday and spoke a lot about some of the economic aspects of Dublin and Ireland in general, which really surprised me. I've got some charts regarding that, just in terms of the relative strength that Ireland has on from some of the macroeconomic indicators. And that surprised me. It might not last forever. So he certainly talked about putting things away for a rainy day, something Eugene knows a lot about. But it was very interesting just to compare the tone that came from some of the leaders in Ireland compared to the tone that we're seeing in the US. This will admittedly have a bit of a US angle. At Moneta, we advise on the US investors, we advise about US assets. We do have a US lens. I think given that the US is such a large percentage of global stock markets, having a US lens is not particularly unusual today. However, I will have a look also outside the US, but I think there's some aspects of the US that really have a contagion effect, really do affect how we think about other factors. So lots to talk about today. As usual, inflation, I talk about the five fingers of the hand: inflation, interest rates, equity markets, geopolitics, and other asset classes. Today, we've got something on gold, something on Bitcoin, because we're really discovering when it comes to Bitcoin how that is behaving. And I think that's been really interesting. And as usual, when we're in a live format and I discuss these issues, I'd love to draw upon the expertise of people in the room, whether it's on the real asset space, the technology space, the financial space, the asset allocation space, and the kind of the allocator's point of view that I mean Eugene would have had. That would be great to get your opinion, because I really think it's more about you and the discussion than it is about me. So a few little subtopics that we'll talk about here is how inflation has now had this electric shock, or really kind of like a power struggle. I do like my puns, so you're going to see a few of those coming up in here. I had a podcast a few weeks ago where I talked about we've got data lakes on the one hand, we have all this data that we don't know what to do with. And we have data deserts on the other hand, and things like private credit, when we essentially don't really have many indicators as to how credit is doing. It's become kind of a bit of a gap there when we're trying to analyze, and we'll talk about this, whether private credit, there are some canaries in that coal mine. And now we've even got data black holes, and that given the shutdown in the US has just come to an end, we have sort of gaps in data, gaps in employment data. And there's a suggestion that will never be filled for October, for example. So what are we supposed to do when we have these black holes? Do we just try to extrapolate, or do we just move on and kind of look at another indicator? So a little bit about that. Central banks, they seem to have this tug of war now, especially the US, between not overstimulating the economy and giving it the lower rates that it's crying out for in some quarters. We also asked the question, who is too big to fail now? And the question around that relates a little bit to China. Has China gone from uninvestable just a year ago or a couple of years ago to now being potentially too big to fail, given its leverage to the technology space? And then I do like the idea of kitchen table issues. I think that's what tends to affect how people think. And it seems we've got some factors bringing AI to the kitchen table issue. So I'll go through some of these quite quickly, and at every point I'll ask you, your own insights there. So what we're seeing in inflation is, in the US anyway, it is coming down, but not down to the base level of 2%. It's hovering around 3%. It seems to be almost like a new target. And one of the most interesting factors, we've talked about fuel, and fuel costs are actually down in the US at the pump anyway, due to inventories building in oil. But everything's focused on now the price of electricity, the price of power. This is the big constraint around data center build out. And there is a concern from a consumer point of view as to whether data centers will take that share of power pricing. But equally, we have the sense that the electricity prices are taking a larger share of consumers' cost, and they're rising faster than overall inflation. But when we look then at what I found fascinating is inflation seems to be dying down as a big concern. It's not being talked about in earnings statements. That's the chart here on the left. It's not really dominating earnings calls. It's when it comes to the US, whether you think there's an inflation problem, it depends on your political orientation. If you're a Democrat, you think it's hovering at 5% or will end up at 5%. If you're a Republican, you've drunk that Kool-Aid and now you think it'll be more like 2%. So there's a real divergence there, and something has to be true in the middle. It shouldn't depend on your political orientation. And there is a sense that it's the US consumers, they are paying the tariffs, that it is the imported prices are higher. We don't really know the transmission effect of tariffs yet. It's slow, but there's a sense that there certainly has come through in pricing. And before I turn to you to get your sense, I'd like to not just talk about inflation, but the economy and activity more broadly. Two areas. Start with the US. We have this divergence between hard and soft data. So the hard data, GDP is strong, earnings are strong, market's strong. Talk about that. But the consumer sentiment has just got quite soft. And actually, I wouldn't say just got. It's been soft for a while, but now it's close to a record low. What does seem to affect consumer sentiment, no surprise, is whether or not that consumer owns stocks. In that the consumer sentiment index on the right, the biggest stockholders are in the top blue line, they're feeling a bit better. No wonder, given their stock portfolio has done so well. But that again can accentuates the divide, the Main Street, the Wall Street divide, and how consumers who don't own stocks, who are the ones who are at the lowest end, are feeling. And then I have a more local vibe check, just coming this to bringing this down to Ireland and the UK. So on the UK side, we have very slow growth, anemic growth. That's definitely facing that stagflationary vortex. The higher inflation, 3.8%, with very slow growth and a pretty, I'd say, a pretty dire near-term economic outlook as well. On the other hand, the ECB is not facing that stagflationary, in the sense that the inflation part isn't there. There could still be stagnation in terms of growth, but it's not there as much. When we look at the Irish, and I did just grab these from the Central Statistics Office, so I haven't, I wouldn't say I've analysed this data too much, but relatively strong labour numbers. Youth unemployment is high, but it's not, compared to its history, 13.2%. We're seeing employment in the construction sector strong. We're seeing a little bit less in the information sector. But the really two staggering statistics out of Ireland, which you know better than I will be the share of US exports. So it's leveraged to US tariffs, particularly around pharmaceuticals, as well as interest rates, as well as debt to GDP, having that low debt to GDP number around 25 to 30%. So that's a really healthy number compared to the US and certainly other developed economies. We know why that is, due to the strong receipts, but certainly if the paying down debt is a priority, which Leo Varadkar had suggested it was, for preparing for that rainy day, that is a strong indicator. So that's what the stats say. That's the hard indicators, I suppose, on here. I've shown you some of the vibe check on the US, and now I'd like to turn it to you and ask, what is your take on the state of the economy, whether it's here or the US, and inflation? Is that number I showed you on the US side close to 3%? Here in the I don't actually know the Irish inflation number. Is that 2, 3, 3?
Just under 2.
Okay, so very low then, quite low in keeping. Whether there's a divergence in terms of economic outlook, or whether we're all kind of having this soft, hard indicator contrast. And Joe, if you'd like to give your insights.
One thing that really kind of struck me in all of the graphs that you went through there was the rising electricity prices kind of globally, and it's almost illogical that gas prices are coming down at the pump, but yet electricity prices are going up. So there's a whole lot happening in the electricity market. Increased electrification, not just of traditional power demand, electrification of transportation through the promotion of EVs, and electrification of heat through a big push on heat pumps. And that's particularly evident in Europe and Ireland. So all of those things require increased investment in the grid. So a lot of what's driving the electricity cost is not the commodity cost of the fuel that's combusted to create the electricity. It's all of the use of system charges, and there is increased pressure, particularly in Ireland, to continue to invest in the grid. We've got a massive offshore wind potential here. We could become a major power generator, not just for Irish demand, but for Britain and continental Europe. But the restriction there is not technology, it's grid investment to get it from the source of generation to the source of consumption. So you're going to continue to see very big investment in grid infrastructure that's going to push up the cost of electricity, because that capital cost needs to be paid by somebody, and it's going to be paid by consumers.
Right, so more pressure. That 2% inflation may be temporary then.
Yeah, absolutely. It's definitely going to be upwards price pressure. I think data centers take an unfair rap on that, because data centers, could actually become a key part of the overall power generation solution and energy demand. They could become, providers of system services to the grid, But unfortunately, in the kind of public eye, it's pretty black and white. You know, data centers are now bad because of increased kind of power demand. But you see some brilliant examples where data centers can actually supply waste heat to local communities and local housing. I think it's those type of integrated solutions we need, not just taking a simplistic view that data centers are bad.
Yeah.
Data centers, whole data, processing of data to provide technical solutions, you know, that can address an awful lot of the issues. I think we need to get better at educating the public about the full, you know, benefit or contribution that data centers make, and not just simplistically.
It certainly seems to be the siren cry of the alarm is around energy pricing at this point, as opposed to the holistic benefits.
Sure.
Thank you very much for that, Joe. And any other insights as to whether this divergence in soft indicators, hard indicators is something that is understandable? I mean, did you sense that we have this artificially elevated sense of the economic strength, which is kind of on a feet of clay, so to speak?
Yeah, I think you touched on an important point there. I think what we're seeing in our analysis is that the US is very much in a K-shaped economy. The top decile of earners, maybe top 20%, are flying it, and I think it's gonna. The wealth effect from owning equities, as you pointed out, is really helping them. But then the bottom 20% of earners are in a real dire situation. You can see from our analysis that the lowest spending decile in McDonald's is really getting hit. You can see that in the company calls Chipotle had a big profit warning a couple of weeks ago, paying $16 for a wrap at lunchtime just isn't happening anymore. I think what was one of the interesting points we saw on we tend to put the restaurants and the dollar stores into our models just because they give a good indication. But on the fourth Friday, the Dollar Trees and the Dollar House and Dollar Generous are seeing a complete fall off in spending. So basically, the lower decile in the US is living paycheck to paycheck. Last Friday in the month comes, there is just no cash left. So it is. Do you think that's the big danger we're seeing in markets? As long as the AI trend is still buzzing, the top decile are fine in their spending. But if that was to reverse, we think that could kind of show the inherent weakness that's under the surface of the US economy.
That's fascinating. And then, I mean, what about the Irish consumer? I mean, I know we're relying on anecdata here. We asked them, how do you experience inflation? You mentioned 2%. That would be low and normal, but yeah, it seems again that we're still on the back of a pretty high inflation feel here, at least for the lower end Irish consumers, any consumer perhaps. So yeah, great. I'll ask you.
I was just going to echo, you said a lot of great points about that. The other key thing too for the US consumer generally and for future generations, and it's part of the reason why in the US the total fertility rate has dropped, you know, precipitously. This is something that you see across particularly developed Asia. Korea has a total fertility rate of something like 0.73. Across Europe, we're facing similar demographic crises in the future. And this is a reflection in large part because there's nothing to buy. There's no housing supply to buy. And what's happened in America, in part in Ireland and lots of the developed world, is entrenched sclerosis, if you will, of systems that do not allow new housing to be built, or any housing that is going to be built is at the mid-high to the very high end. And so the newer folks, the new formations of families that would buy, for example, in the US, a 1,000 square foot starter home or shotgun home, as we used to call it, they're unable to do so. And if you're unable to do that, and if you're working two jobs, neither of which provide you healthcare benefits, and the healthcare benefits that you do get on the public marketplace are insanely expensive, then life just grinds to a halt. And if the one place that you used to go, Taco Bell and McDonald's for food, which I used to go to and still love to go to, I wish they had them here in Ireland, at least Taco Bell. If you can't afford that anymore because the inflation rate of paying for those is greatly exceeding the general inflation rate, then your life kind of grinds to a halt. But this bifurcation, this K-shaped economy that he spoke of, is exactly what I'm seeing from the friends and family that I have on both sides of the economic spectrum.
Yeah, fascinating. Eugene.
Yeah, I take the perspective maybe more of an allocator and for as a long-term investor, and I'd sort of split out inflation and economic activity, which can be constrained, and just as has been discussed. But thinking about inflation as a long-term investor, I always think inflation is the enemy of a long-term investor. I'm old enough to remember the 1980s when inflation was double digits, and I think it's really important for investors. It's easy to discuss what has been on the slides in terms of their much nearer term. But I think the most important thing for a long-term investor is to have the portfolio constructed so if inflation does ramp up, that you've got plenty of assets in the portfolio that will do okay in inflationary times. Inflation-linked bonds, real estate, land, maybe housing, as has just been discussed, gold, commodities, those. And I think probably not enough attention is paid to, that's the extreme scenario that will kill all long-term investors if inflation is 10%. And we're probably collectively not actually well positioned, as a starting point for that. And I would think we should get that foundation and then, tweak it tactically based on how we think, the more nearer term, shorter term.
Well, you have some good people in the room about being building in inflation hedges with real assets, etc., in the portfolio. And I think this touches on so many things because, right, I don't have a lot of size. There wasn't a lot of activity when it came to bonds recently, but we have the double whammy of inflation remaining high, bond yields coming down. That may be an attempt to address the housing problem if we can't, with mortgage rates coming down. That seems to be one issue, and so that will then drive more risk on seeking behavior. I will say real assets, real estate have been traditional great sources of inflation protection, but we have the question, well, is real estate as good in inflation protection anymore? Do things toggle in the same way with inflation? Do landlords have that ability? Do owners have that ability? And then the other thing is just around real assets. Some of their business models have been impacted by interest rates being high. So do they have that ability? Not a lot to say on rates at the moment. The Fed seems to have this tug of war. They say bonds like that bond volatility has been higher. It's actually even lower now. And the interesting thing about bonds, they seem incredibly calm. All this consumer problems and bankruptcies and subprime lending, bonds seem incredibly calm about the whole thing, which is a bit of a surprise given they tend to be the alarmists, you could say, in markets. And even in the UK, when there's been quite a lot of, let's say, chaotic developments on the leadership side and in the government there, even there we haven't seen gilt yields jump out. So it's a bit of a surprise as to why, and we can see that there's quite a lot of money growth has been trending up here. There's quite a lot of liquidity in the system. So this is a bit of a surprise, but the point being, if rates come down, which the Fed is probably 50-50 likely to do, that then puts more pressure on investors to seek their real return will be brought down. I want to move to the stock market now just to talk about some of these factors. And I think this is interesting. You mentioned we need return to overcome that inflation. This is about a week old, this chart, but it's regarding what's happened. They took a score the 1 year since Trump was elected and what have been the outstanding winners. Well, we know that certainly there's been a risk on trade. Talk about Bitcoin later. That's had clear tailwinds from the Trump administration. But European defense, perhaps not a natural we all know why that has the kind of collateral effect on the effect on that. The Kospi has done well. There's a big tech play. MSC China, again, a tech play. And I'll show a chart later showing why some emerging markets are actually very much tech plays. So you may not be getting that same diversification with emerging markets that you would have said. Gold, we could do a whole podcast on gold as to why gold has been up and over 50% and up to 60 and come back a bit this year. That's a bit of an alarm bell at the back, saying around inflation, around concern about the government debt that is more of an issue elsewhere, not here. And we know that, but I think that's another big picture there is clearly the US. And this is a recent thing from Visual Capitalist, and it doesn't even show the individual stocks. But if we just look at what's happening in the US, and US exceptionalism has kind of now become its own self-fulfilling prophecy when it comes to the share of market cap. If we have the US at 62.2 trillion, the entire EU at 11, the UK at 4, Canada at 3, we now have entire individual stocks that dwarf whole companies and whole countries, should I say, whole countries and their stock markets. And why this is important, because it is, as I said, when you have a market cap way of investing, it keeps reinforcing this. But also it makes for a very volatile portfolio if you're following this, because you will have individual stocks. And I'll just show a quick example of that in Tesla. This is Tesla here, down 8% in a month. But, big, it did drop when we had the $1 trillion pay packet awarded to, or at least agreed for Elon Musk. So individual stocks are moving 8%, 10% a day. And if you have an individual stock that is the size of the UK stock market, and that moves 10% a day, and that's a large part of your portfolio, well, you're going to see a lot more volatility in that part of your portfolio than you would have seen in previous times. I want to come back and ask about this, but this chart here shows, I mean, this, everyone who follows markets will have seen many versions of this chart. Equal weight in blue, cap weight in black, massive divergence there. Clearly, there are some stocks, many stocks being left behind. There are 40% in the top 7 stocks, essentially, and the top 10, but the top 7 really dominate most of that. And so we're all talking about AI, we're all talking about tech. That is clearly the big driver of equity markets. And how does that then factor into an equity allocation? Do we think about it differently? Go ahead.
Yeah, I think this chart is probably the most important chart for the next decade of markets. Look, we've been battering on about it for the last year. I'm sick of hearing myself talk about it, but the US is 5% of the world's population, 25% of the world's GDP, but 70% of stock market exposure for most people. And we just think that it makes no sense on any level. So I think, especially for us here in Ireland, for the last 15 years, you've had a lovely ride that every time the US stock market has gone down, the dollar has appreciated and bailed you out. And we think that era to us feels like it's gone, that the dollar is on a permanent structure of decline now, so you won't get bailed out by the currency. And you're investing in a very expensive market, in a very expensive currency, and you kind of look around at the rest of that graphic and you think, okay, there's pockets of expensiveness outside the US, of course, but even there's plenty of cheapness. And even if I think that the equal weight chart versus the S&P chart is the big one. I think for the next 10 years, historically, equal weight has beaten the market cap weight. I think if we revert to that historical performance, there'll be a lot of people caught offside, and there potentially could be a lot of pain if the bonds don't do their job, which they haven't done in 2 of the last 3 crises.
So I mean, I think this is really important because I mean, it's a couple of things. Are China is becoming, in a way, the two are marching in sync. I have some charts here showing China and how much China has been. We have a lot to talk about in terms of AI, but in terms of just this chart here, emerging markets and other tech playgrounds. And that basically shows just the exposure of emerging markets versus other developed markets, non-US. And you can see that emerging markets very big on technology, big on financials, but the industrials, the healthcare are much more the other developed markets. So when you're diversifying your portfolio, you're still, if you invest in China, you're still loading up on technology. And there's huge amounts of basically the whole AI picture seems to now be, well, Taiwan is entirely about that AI story. And we can also see this chart, I think, is interesting in terms of China. And it has been a bit of a sleeping, I'd say not sleeping giant maybe to all of you, but certainly in the US, there hasn't been as much focus on just how much China is achieving on the AI front, how much they are forecast in terms of how much China being the red line and US being the blue line, what percentage of GDP they will represent going forward. If we're here today and we see that the US is dominating, those lines will cross in about 15 years and just keep going, another K-shaped chart on the board. So if we have this and lack of regulation, sure, and definitely unbridled investment and probably data centers and energy galore. But this is an important chart because China, this is why I asked whether China is essentially getting too big to fail. And we've seen flows go into emerging markets, even though we speak about US equities, we've seen flows go in. The EM has been not really reflecting its higher risk premium, but it is, you've seen flows go in. So I suppose, like, getting back to those of you who try to be, before we start talking about the AI bubble, which I think could be a good discussion here, global investing. I know that it's been done for some time. You know, how do we tackle global investing when we have this kind of dominance of one big player?
We're certainly finding with our equity managers, keeping diversification in the portfolio is very, very tricky. We're looking at it from 2 lenses. We're looking at it from the European lens, where there will be more limitations. If you think of the end product for the fund, which is UCITS, there are quite a lot of concentration restrictions. And then compare that to the mutual funds in the US, where I suppose UCITS are losing out in terms of excess performance there. The most recent discussions we've had with our equity partners are around, you know, there still is very much this discussion around Mag 7, and they're trying to protect for, while they don't see that bubble is going to burst anytime soon, I think, like you said, Eugene, just trying to think ahead to how to protect on that, and diversification is certainly still a big conversation there. But how do you face clients when you've missed out on the run up at the same time?
Yeah, it's a brutal time for active managers
Yeah.
for that reason. Yeah. Any other thoughts? Go ahead.
Yeah, I would have thought that you know, the concentration and the risk exposures we have on that chart are sort of at an extreme. The quantum, that Derek was saying, the US as a percentage and the Magnificent Seven as a percentage of the US. And so I would think that most people with money won't really want that much risk in their portfolios. And I think the big question for asset managers and professional asset managers is, do they have the courage to go against the market cap based benchmarks in order to diversify the risk a bit more? And that comes back then to the client. You have to explain to your client before you do this why you're doing it. And what you might miss out on is if the market is up 25, if you're more diversified, you might only get 20, but actually 20 is pretty good. But it does, but for the broad range of possible scenarios, a lot of which are pretty bad, you would want a more diversified portfolio. And I think asset managers need to have the courage to actually go away from market cap based benchmarks from a risk point of view. Not saying they're smarter than the market, it's just the risks are too big for the client's risk appetite. Typically, there will be the odd client who's happy to ride the AI bubble, but there's very few of them.
That's the tug of war, right? It's the tug of war between FOMO on the one hand, if your bonds are yielding nothing and your real estate's controllable and your real assets haven't gotten, say, there's that headwinds around regulation, and the desire not to miss out. And then you listen to the tech story and you think it's kind of going to the moon. And then yet on the other hand, how much risk you need and how much risk does equity represent when you have a stock like Tesla that can fall like that in a day.
Yeah, I'm not saying to sell Tesla or Microsoft, but you know, to have their weight or whatever, you would still be participating significantly, you know, if the AI and everything keeps going. But it does require conversations with the owners of the money beforehand, in a sense, to explain what you're going to do. Because otherwise you are at the risk then of you know, the asset owner will just the money owner will complain if you miss out on.
No, that's a really interesting thought that we're at an extreme in terms of this patchwork quilt. You'd say, Derek, do you want to come there?
No, I echo everything. I think if this was held this time last year after the kind of the Trump inauguration, I think everyone holding an underweight to the US was absolutely in misery. But I do think this year has been positive. It's shown that European equities can go up. And over the last 5 years, European banks have been outperforming the Magnificent Seven, which is surprising to most people. So I do think we've seen this year has brought glimmers that there is life outside the US, and I think maybe we're on the path of that that kind of concentration on unraveling a bit.
Yeah, it doesn't help when BlackRock say stay overweight the US, and these helps are not particularly helpful, or people say there's no systematic risk. On that point of are we at a peak? I think we have to talk about AI, and where even this week there's been ripplings of peak. And I'd love to bring in both on the tech experts as well as students who are coming out into the world of using AI in terms of use case, because I think often we are not connected necessarily. Those of us maybe I speak for myself as connected. So a couple of things just before to kick off the conversation. Clearly, the big story has been, I mentioned the concentration of those AI, quantum stocks, again, trading in a league of their own. Price to sales ratio is kind of, unheard of at 500 times. We're seeing the price change pretty significant. This is the capital expenditure from just 4 companies: Meta, Alphabet, Amazon, and Microsoft. Big, bold capital expenditure plans. There's the infrastructure stocks, mentioning data centers. They've also participated really well. Cooling companies, components. It has trickled down the cap spectrum really convincingly that this is definitely a movement. But I suppose the issue that's been coming up, and that has been that we know has been an issue here, is who pays the piper for this? Essentially, so far some of these companies have done it out of cash. Sometimes they're raising debt, but a very subtle way of paying the piper is just don't pay us. So you just don't take that money and invest it. I looked at a chart recently, a client showed me expecting 9 trillion per annum on climate change mitigation. And whereas AI is 2 trillion per annum, and clearly I said, well, 2 trillion is already outlandish. 9 trillion is never going to. So therefore, if the what may have been assigned to climate change mitigation is now going to AI, there still won't be enough to cover the AI. So clearly it's going to come from capital, from human capital, labor, headcount. There's already been headcount cuts. Question whether they're made because of AI or they're made to pay for AI, which doesn't necessarily mean that they're being replaced by AI. So we know that funding to data center spend has been exploding. And who's worried about that? Well, very high profile short seller, Michael Burry, has been calling who's been focusing on depreciation that has not been accurate for some of the chips, that's suggesting it's been extended too much. And that's really been reducing earnings. That's been his suggestion. He just closed his funds. So gather from that what you will. And then on the kitchen table, JP Morgan has done an interesting analysis suggesting that if the revenues of 650 billion per annum will be achieved, that would be the same as every subscriber for Netflix paying 180 per month, or every iPhone user paying $35 a month. That will never happen. I can kind of confidently suggest. So the consumer is not going to pay for this. So it will be the enterprises that pay, if at all. So, and markets have started to get wind of a little bit of concern around this. So you mentioned, are we at a peak in terms of US perhaps exceptionalism, focusing on the thing? Where are we here? And do you think some of us have got ahead of ourselves, or in terms of predictions? And it's wide open. So whether you guys think it's something that you use and will use and can see yourself using more of, or on the tech side, do you think that this is only in its infancy? Any thoughts? I'll just make we should really be able to ask AI, but we can't, right?
Scary thing from our side is just what looks like a humongous misallocation of capital. No one is still able to, as that chart points out, no one is still able to show how these hyperscalers are going to get a return from this, and no one knows who the winner is going to be. I remember when the internet came out first, using Alta Vista and Yahoo, and these things are long dead. So I suppose the first problem is picking a winner out of all these hyperscalers, and the second problem is walk me through how the model works, how the business model works. You can see ChatGPT, everyone's using it, make money off us. So it's just it's very confusing time, and I saw Michael Burry shut down his fund during the week, and I think he was banging his head against the wall, and we're doing the exact same. We just can't figure it out.
Yeah. And I think another reason for him banging his head and shutting the fund is he said, I see this doesn't make sense, but will there be a lender of last resort, an emergency line, or basically will institutions step in to avert a crisis? And we know since 2008 they do that. And we know that there's such an intersection of, I don't have the chart that's the elaborate kind of flow chart because you've updated weekly, it seems, who's connected to who, and if one falls, what happens then, and TSMC is connected, and then your global portfolio is all in sync. So there's a lot of interest, and it's very complex. Quantum computing, I admittedly don't really understand what some of these companies do. So if there's that complexity, do we understand what's being bought? And will this be justified? And that's, I think, there has been some big questions raised, and a lot of factors at play. I'm sure there's some more insights there.
The question really just your view and the market view on the threat to some of these big AI players from China.
That's a great question. And I think something that we're not all paying proper attention to. I think we saw with DeepSeek recently, which was this is a shock that's almost in memory, that China has the ability to copy very quickly. And just getting back to what Derek mentioned about the use case, do we need the highest use case for all of these models? Or are we kind of just coming in at a kind of what's there used to be the kind of the Tesco, the yellow brand? But do we need the high end Waitrose solution, or could we be happy with the way the Tesco cheap, so does what we want solution? So if that's the case, then the Chinese free open source solution could very well be perfectly fine. And we've seen that already. I think it's Cursor this week has been discussing that we've seen that there's plenty of easy substitutes for some of the LLMs. And the other thing is that maybe enterprises are using 3 LLMs now, but they will decide on one. They don't need 3. They certainly can't afford 3. And if the price goes up to the 180 per month per consumer, and that has to be borne by the enterprise, they certainly won't afford 3. They will take a lower cost option. So I think that is a real threat from China. Go ahead, Alex.
I would just say a couple things that I keep testing AI model tools and keep searching for these other answers that I can't solve. So one thing I would challenge all of you to do when you go back to your office and look at any AI tool that you're using is ask it to draw someone writing with their left hand. And it can't do it. It also cannot draw an analog clock with a time other than 10:10. The reason for that is because the reference sources for those pictures are all with people drawing with the right hand, or all a clock showing the 10-10 time, which you've seen in all advertisements. When I try using AI tools to just do simple data extraction, I get errors that I then have to fix, which seem like this should be the easiest thing for it to solve. But the larger question for me is not the current inadequacies of AI tools for simple or even complex tasks, which I'm sure eventually they'll be able to fix that and get there. And we'll move from being pattern matching tools to actual intelligence tools. The bigger question for me in terms of the value from the CapEx that's being spent, the justification for it, is what's the point? The point when we were discussing 25 years ago about laying the dark fiber and spending the CapEx was the inevitability that we all felt of everyone coming online, everyone doing a million different things. We had a million use cases if we had that bandwidth, and so we could justify that CapEx. But today, when I hear about the use cases of AI that people are actually using, if it actually works, is like, great, I can make software faster, I can do some coding faster. And so my question in response to that is that a big problem? Is that some enormous problem that we've been trying to solve for years and thank God AI can finally do it? When I hear about advances, because my wife is a scientist, about the ability for AI tools to find innovative research advancements, it's like, okay, well, is that enormous profitable problem that we've all been trying to solve and we have not been able to until, thank goodness, AI is finally here to save us? And so that's the one big thing I'm always looking for is like, great, why does that matter? Well, yes, it's interesting, but does it have actual utility? And then further, from a business perspective, does it generate not just the revenue that's expected that, I'm paying $20 a month for ChatGPT Professional, but does it actually lead to some inevitable profitability because it has a use case that we can all be happy with?
Well, I think that's a great point, and then this exactly I think brings in the debate part. Just finally, so I want to be mindful of time. Just on the young side, do you use it a lot in your day to day? Do you think you'll use it more? Can you see yourselves using it in the workplace?
I think it has its certain uses, but they're very limited.
Okay. Yeah.
I saw a study by Apple that once you go outside of what it's learned of, it hasn't got a clue. It just doesn't know what to do. So I think it's useful to like maybe reword a few letters, but beyond that, it's really bad. Like handling data, I'll give it a data set, and then it says it's exported the results, and then it's blank, and you're like, oh, why did you do that? It's like, oh, sorry, it's not actually finished. Give me an hour, and then it just can't do what it says it can do.
Yeah.
So I think there's a lot of
there's a bit of Kool-Aid being drunk and being exposed to that, for sure. And very quick, but I think this gets back exactly to the to Eugene's point about diversification, because if we have this question mark about whether this is sustainable, it's representing 40% of our portfolio. Well, clearly we need to diversify not only into the different equities, but into real assets, into some of the other areas. And I say just one last thing here, just that there are two more factors just to cover is the other asset classes. A little bit about Bitcoin. I think we haven't really advocated for use of Bitcoin in portfolios. We know it's partly because we just don't know how that's likely to behave. We know it doesn't like a US-China tension. It seems to go very volatile when anything there breaks out. It did seem to be a bit of a canary in the coal mine around an impending correction. That's certainly a little bit of a correction in place. I'm not sure we'd call it a correction yet. It does seem to be a very high risk on asset. So not digital gold anyway, because gold has kind of done what we would have expected it to do. It has been that inflation hedge. It has been that diversifier in a portfolio. It has been doing quite well. And then finally on the Forex, we've had a bit of a surprisingly strong dollar, I'd say, which has been, we haven't really necessarily had a good sense as to why the dollar has been as strong as it has, given the various uncertainties around the US. But so far, it seems to have stabilized, and there's a lot less volatility in foreign exchange, which has just been a good thing for certainty generally. So that is all I had in terms of prepared remarks. We've kind of talked through many asset classes here. Thank you for your insights. We will be continuing to watch, even as the markets break today, just how these stories are being received. We mentioned the lower end consumer, they may be getting a $2,000 check from at least in the US, so that may kind of give them a little bit of a boost as we go into the all-important holiday season. But we are, I'd say there's a little bit, we haven't even talked about private credit today, but clearly on the credit side, we do have, that consumer is not necessarily able to make credit card payments, and the subprime car market has been under strain. So we know that there are cracks here, and our job is to really just keep scouring the horizon for where we see signs so that we can at least try to join some dots around the next bubble. Great. Well, thank you very much for coming, everyone. I hope you get to meet each other and have some nice contacts.